Welcome to Commercial Conversations Over Coffee, the show where two college dropouts turned real estate millionaires discuss all aspects of commercial real estate investing. Now, welcome your hosts, Tyler Cobble and apartment guy Bruce Peterson.
Happy Friday, everybody. Thanks for joining us live on Commercial Conversations Over Coffee if you are with us on YouTube. Bruce, what's going on, man? How you doing?
I am doing fantastic. Had another good week of business. Still trying to clean up some of the properties that we've sustained lots of damage to in Austin and San Antonio. But things are good, man. Things are really good. How about you?
Yeah, what went well, aside from, getting things fixed up?
Well, I went out to spend some time in Utah, learned about microdosing psychedelics. That was kind of cool.
Nice.
I think I want to do that. I've always been interested in that. I've never done an illicit drug in my life, but I'm fascinated by going through a guided, controlled microdosing experience with somebody that's very experienced doing it. So, did that. We've got a couple of projects that we think we're going to get one under contract today, you and I. And another one you and I are working on that we're managing currently that we might still have, still might be alive. So we got some good news today on that front. So things are going well there. Overall things are going good. I've got a lot of things in the works for Apartment Guy, for my educational platform. We're going to kick off some seminars. And so, things are really, really good in our life.
Yeah, that's awesome, man. Pretty excited to be working on that one that you just mentioned. Not too far from the provisionary. So hopefully we'll be getting that one under contract today. The seller has agreed to all the terms, and we're just waiting for him to sign. Pretty exciting.
Beautiful. One. Yeah, it's gonna be another cool one to kind of put our flag, plant a flag into East Nashville again. So you're out there finding lots of good deals. We're operating good deals. So, we will dominate East Nashville if we're not careful.
That's it. Oh, well, let's not be careful then. Let's not be too careful. So talk to me about all the apartment units that you've got down. I mean, I know we've discussed it a little bit, but I mean, what's it like going through all of that now?
Well, it's not fun, first of all, obviously. So we talked about it a little bit on the last episode that on a 200 unit property in Austin, it's the one that's been hardest hit for us. We have roughly 23, 24 units either heavily damaged or completely destroyed. And, we're just having to work through that. The first step we have to do is go through and gut the units. We have to completely demolish or demo the units, get all the wet, the damp, the moisture out, and then set up fans for multiple days, 5 to 7 days to get that thing dried out completely. Then we go through, we've already had the insurance adjuster come out. It's going to definitely be an insurance claim. But next we have a company come out to give us a proposal and a bid to build all that stuff back. So we got to build roughly 25 units back to the way they were or better. Hopefully, we'll be able to make some units a little better than they were. It's a way for us to test some new units, some new build out, some new upgrade levels. So, we'll come out of it okay. It's been tough on the residents. Some of them have been displaced. We don't have enough empty units to move the people that are uprooted into another unit. So some people were just having to terminate their lease, unfortunately, and you feel horrible about it, but I can't let them live in a damp, moisture ridden apartment. It's unsafe for them. It's just managing through the whole process with our staff, with our insurance company, with a bunch of contractors, the adjusters. Again, it's not fun. Luckily, we keep a lot of reserves on hand on these properties. So our deductible for our insurance claim is going to be $50,000. Well, we carry hundreds and hundreds of thousands of dollars in reserves for things like this because, who knows what's going to come up. A lot of people would say, well, I would just keep one deductible on hand for an insurance claim. Well, what if you have 2 or 3 insurance claims at one time? I've never had 2, but why couldn't that happen, right? So I would never just carry one deductible. I would carry one deductible plus 1 month's complete operating expenses and debt service. That's why I carry more than most people think I should. And some of my investors aren't always pleased when they see the balance sheet that we send out in our quarterly updates But that's why we keep so much cash on hand. Yes, it would be nice in each individual investor's pocket, but it's for things like this. I have to be sure that we can protect this property and this company if things get weird. We went through COVID, and now we're going through this, what, the snow apocalypse or whatever they're calling this thing that happened, this Arctic blast that we've never seen before in Texas. So we're very conservative in the way we approach things, and that's why I try to teach people to be very conservative. And this is another reason why, if you want to go out and syndicate, bring other people's money into a deal, it's not easy, because you have to explain to people what's going on, and all the heartache and the headache and the stress that you're going through right now. But it's worth it for me, but it's very hard.
Yeah, I mean, it's just investing smart, right? I mean, eventually they're going to get that money back anyway. You want to have it on hand in case anything comes up. I mean, like you were saying, you've got to get in there and demo out all of those units, and then you've got to work with the insurance agent, right? So somebody's got to get paid to come in and do all of that work before you're getting any insurance coverage on it. So.
Yeah, it's interesting. I've had the demo contractor, he's very concerned for us. Hey, how much do I need to do? I need to kind of space this out, time this out so you can handle it financially. I was like, no, 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 no. I understand what you're doing. You're trying to help us manage the cash flow situation for that. No, gut it all now. I carry enough money on hand to do this, and I'm going to get it back less $50,000 in a deductible from the insurance company. So, it just tells me that there are a lot of people out there that aren't prepared for these big capital events to happen when a contractor that deals with this stuff. They're trying to help me manage the flow by doing a few units each week or each month until we can get more rent payments come in. Maybe I was like, no, 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 don't think that way. Get it all done now, immediately. Get it done yesterday. Bring in 40,000 people if you need to, 100 million fans. I don't care. I've got the money.
Yeah, that's pretty amazing that a contractor would ask you that, right? Because clearly he's been through this before, where somebody was like, "No, we've got to do like 10 units at a time." I mean, and I couldn't imagine the further damage that you would be doing to a unit in that scenario, right? Because you've got to get in there. You're tearing out that drywall because it's going to mold, and
Right.
if you get in there early, you cut out the first 3-4 feet of that drywall, and you're good. If you don't, you've got to remove all of the drywall and all of the units because all of it will start to mold. I mean, it's just the bacteria, the mold loves to get in there and multiply.
Oh, absolutely. So, and try explaining that to your insurance company, that I am purposely not demoing and drying out units because I don't have the money. They are going to be pissed, and it's going to affect your claim, because they're going to say, look, if you had done this right from the beginning, you wouldn't have had nearly the damage that you do now have that you're trying to claim. I'm going to give you maybe 20% of your claim, or 50% or 80%. I'm not going to give you the whole 100% because you didn't manage this effectively. It's not my fault as an insurance company that you had your head in your ass or you didn't carry enough money on hand. So it could really cause a lot of problems there too. But, once we start building this back, I'm talking with my staff. What you do is you triage. You look at, so when we have this contractor come in to help us build everything back, I'm not going to have my guys do it. They have work orders and the regular everyday keeping the property running stuff to manage. So we call in an outside company that helps us do this. And so what we'll do is say, look, okay, we have 25 units. Which unit is the close to being brought back online, has the least amount of damage that you can get up, turned around as quick as possible? Go after that one first. A lot of people that get into this industry as a newbie, they just assume, no, you go after the hardest one first because then it gets progressively easier. No, that's completely wrong. As long as that unit is empty, you're losing money in vacancy. Get the fastest one you can get back online and released as quickly as possible, right? So, we will triage, we will manage through that, we will prioritize. I'm grabbing a calculator, sorry. So you do this in a very smart, calculated way, and for some people, it's counterintuitive, but that's how you do it. When you have unit turns in just normal everyday business, let's say you have a 200 unit and you have 10 units vacant, right? Which one can you get back online the quickest? Because the quicker you can get it up online, the quicker you can get somebody in that unit and start contributing money to the bottom line. So you always go after the quickest turn first, always.
Yeah, I mean, every day that you're not making $1 on a unit, you're losing a significant amount of your valuation on the property too. So it's not just about the cash flow. It's about, if you're trying to sell the unit the next year or two and somebody sees those numbers, they're going to devalue your property a little bit.
Exactly. So, one other thing to think about too, if I've got 25 down units, it's actually, I always refer to it as a 200 unit, but it's 192 units to be exact. 25 units on 192 unit property, that's 13% vacant. So my 100% full would now be 87% full. So if I lease every single thing I have possible to lease, the best I could ever do right now is 87%. So now if you apply maybe an industry standard where you are of 10% vacant, well, now you've lost another 10 points. So now you're at 23% vacant, which is only 77% occupied. That starts to get dangerous. That starts to get really, really, really low. Luckily, if you have the right types of insurance, that's why you always need to use a commercial insurance company, somebody that specializes in multifamily. So we have lost business, we have lost rent coverage. So we will be made whole on the rental portion that we are not able to collect. So they're going to look at what our historical occupancy level has been, see where we are currently, and they'll cut us checks to cover the lost income. So make sure you have the right types of insurance, not just liability insurance, not just enough to keep the bank happy, your lender happy. You need to make sure that you have the financial wherewithal of your company protected properly.
Yeah, you never know when something crazy is going to happen, and if you don't have the right protection. I mean, I was talking to my insurance broker because there was a bombing in Nashville over Christmas, and they were talking about, I guess, there was only one business that they were worried about because they didn't have, they didn't have terrorism coverage. Every other building had terrorism coverage, and fortunately, the federal government didn't declare it an act of terror. Because if the government declares it an act of terror, then the insurance companies go, oh well, sorry, it's an act of, you don't have terrorism coverage. We're not going to come help your building. Fortunately, the government didn't declare it an act of terror, and that guy ended up getting his building covered by insurance. But I mean, we just went through that on Newell Tower in Chattanooga. I was going through our insurance policy, and I think it was only like, I don't know, 20, 30, 40, 50 bucks, maybe $100 a year to add terrorism coverage.
Yeah.
And so it's just one of those things where why take the chance? I mean, could you imagine if you had a $6 million building or an $8 million? I mean, that building would cost us about $8 million to build it back. If we had that and we didn't pay $100 a year for terrorism coverage and something happened, the risk isn't worth it. Like you said, it's better to be conservative.
Right. And a lot of people will say, well, the deal doesn't work if I have to put this insurance on it and that insurance on it, and I have to be covered for lost income, and I have to be
Then it's
covered
not a
for
deal.
terrorism. Well, then it's not a deal. Exactly. You're
Yeah.
making a deal work that isn't a deal because you're cutting corners and taking dangerous risks. Now, you might come through it on a property or two or three unscathed, but eventually that shit's going to catch up with you, and you're going to be stuck holding a dead property. Don't do that. If it can't support appropriate insurance, don't do the deal, guys.
Well, speaking of good news over the past week, let me see if we can get this shared. So Nashville and Austin investors plan to buy Madison Town Center. So this actually ended up getting leaked yesterday or 2 days ago by the Nashville Post. We haven't quite closed on it yet. But I am partnering with a group called Artesia out of Austin, Texas, on a 330,000 square foot shopping center up in Madison. They've got this beautiful picture of the rendering that Hawkins Partners did for the development, but excited to be closing on that one. By far the biggest deal that we've done. So I can't really drop too much about it at the moment, but figured I might as well acknowledge it since it's going on.
Yeah, because if anybody's watching us right now and they look at that picture and go, wait, 330,000? How is that possible? Yes, it's much larger than 330,000, but there's magic on the way.
Yeah, I think the rendering shows about 3.75 million square feet.
That's unbelievable.
Yeah, but currently it's just a shopping center. So excited to get that one going. I mean, so Madison, for those of you who are not familiar with Nashville, Madison is just north of East Nashville. So basically my sandbox adjacent. And the growth of Nashville is moving up that way. Madison is a phenomenal part of the city. Green Hills, which is arguably the most, I guess, the one of the wealthiest parts of Davidson County. It's got the most expensive, most high end shopping district there with the Green Hills Mall. It's about 15 minutes from downtown Nashville, but it's closer geographically. Madison is further away from downtown, but it's actually closer drive time. It's 12 to 13 minutes to downtown because it has such good access. You got several interstates, and you've got I-65, you've got 24, you've got Briley and Ellington Parkway to get into town. And it's got one of the biggest hospitals in Middle Tennessee there, too. So a lot going on for that part of town.
That's exciting. So that's so you've got Madison, we've got Newell, we've got the Provisionary, we've got this new deal that we should be under contract on today. We've got an apartment complex we're hoping to be under contract, in the next, 2 to 4 weeks if things break right. So yeah, we're rolling, brother. We're rolling. It's a lot to keep up with, but man, is it exciting. It's engaging. It's got us all just fired up all day, every day, thinking about what do we need to do next? Who do we need to hire next? And that's the fun part to me, in a large part, is what other jobs do we get to create for people? What other people can we bring into our world? That's a lot of the fun for me.
Yeah, it's so much fun actually building functional companies. Instead, it's one thing to be solopreneurs and to go out and do everything on your own, but once you start building a team around you, it's so much fun to, because everybody brings something to the table, right? And it's so fun getting, Brooke's perspective. She's our new property manager, and Andy's perspective, and Julian's perspective, and Ben, and all these people that we've got on our team. Yeah, Jordan. I mean, it's everybody brings something so unique to the table, and everybody looks at it differently, and it really helps. So yeah, I've been really.
Yeah, don't forget to mention, not that they're going to watch this podcast probably, but our back office guys, right? We've got Walker, we've got Catherine. We've got just a superstar team. And the reason we have that superstar team, this goes to the entrepreneurs out there, or the entrepreneurs to be, is because we don't tolerate substandard performance. And I don't mean that to sound rude, but if you're not what we need, we have to politely part company. And we have to keep going until we find that right cog to place in the machine, right? Because we have an unbelievable team we've assembled. It's taken some time, and we're going to continue to grow and grow well. We're only as strong as those around us because they know their respective job better than we do.
Yeah, and it makes our lives so much easier. I was going to say the reason that we're able to keep acquiring these properties and moving on to the next one is, one, because Bruce and I make a good team. Right? I mean, I'm deal flow. I go out and I find the deals. I put the idea together, and I say, "Hey, Bruce, let's do this." And he goes, "Okay, well, slow down. Let's make sure the numbers work. Let's do this. Let's do that. Make sure all the systems are in line." And then basically, so I go out and source it, and then I hand it off to Bruce and his team, and it's such a good system. But then it's the same within our team, right? Like, you and I go out and find the deals, and then once we've both done our thing, we hand it off to the team for them to run. And so
exactly,
it makes our lives easier. Well,
absolutely.
Speaking of making our lives easier, today we're going to be talking about structuring syndications, 506B versus 506C, the different tax implications of different syndication structures, and hopefully we can make your lives a little bit easier by pulling the curtain back a little bit on how these deals get structured, because there are so many different ways for you to structure a deal that it can get overwhelming at times to, learn how to put your first one together. I mean, I know that I researched that quite a bit. What's the best way to structure these deals? What do LP investors want to invest in? What do they want to see? Do they want prefs? Do they not want prefs? How much equity do I give? So let's dive into all of that. Bruce, what was the first structure that you used when you acquired a property?
So the very first thing that I did, and most all of my deals have been what's called a 506B. So that's kind of where you start. How do you want to structure it within the registration that you have to do? It's limited registration, but you have to register these offerings with the SEC. So you have to decide, how are you going to structure it? Most of you will do a 506B or a 506C. Almost all of mine have been 506Bs. I've done a couple of 506Cs along the way, but the big difference is, say, a 506B says you can only let friends and family, so to speak, people that you have pre-existing relationships with, invest in these deals. That's it. If you do a 506B, that's the only people you're allowed to invite into these deals. If you have a deal and it's a 506B and you meet somebody tonight at a meetup, you cannot offer them the deal. You don't have a pre-existing relationship with these folks. But a 506B allows you to bring in people that are not accredited investors. So it's a little easier for most people starting out, provided you have enough quote unquote friends and family on the sidelines ready to go, right? So what accredited means is somebody, these are general definitions, and these are the two most common definitions that most people will qualify as an accredited investor. Number one is, do you make $200,000 a year each of the past 2 years as an individual, or $300,000 each of the last 2 years as a married couple? Or and you expect to make that this coming year? Or are you worth $1 million, excluding the equity or the value of your home, your personal residence? You have to fit one of those two definitions for the most part. There are other ways, but that's what most people will qualify under to be considered accredited. If you do a 506B offering, you can have as many accredited investors as you choose, but you're also allowed to have non accredited investors. But again, those people have to be pre existing relationships, friends and family. Secondly, you're not allowed to advertise or promote or solicit for your deal. You can't go to a meetup or a real estate conference and stand up on stage and say, "Hey, I got this new deal. You want to invest?" You're not allowed to do that. You have to, again, have pre-existing relationships with people. They have to come to you, say, "Hey, I'd like to be considered for deals that you work on in the future." You can't talk about them on Facebook, Instagram, TikTok, and LinkedIn. You can't talk about them anywhere. You can't even put past results on your website. If you have a website, say, "Hey, these are all the deals that I've done over the years. This is how long we held it. This is how much we paid for it. This was the return to the investor." You aren't allowed to even do that stuff if you file a 506B. Now, you can post things about your past deals, but you can't go into performance. You can't go into returns, because that is seen in the eyes of the SEC as a form of solicitation. Even though you're not giving it to some one individual individually, you are broadcasting it out to the world at large to say, "This is what I do. Come to me." You're soliciting,
I,
indirectly soliciting.
I've got a quick question on that. So
Of
if
course.
you're doing 506B and 506C offerings, could you have the 506Bs on the same like page on your website, like our investments, right? Like you've got an investments page on your website.
Okay.
Could you have the 506Bs with no return or investment information, and then the
Nope.
506Cs could have
Nope.
returns?
Nope.
So no, not at
Because
all.
anybody looking to see who you are, they're going to see all your deals. And that's the whole thing. You can't show them returns that you've expected. Now, again, you can list your deals, but you can't put returns up there. Now, if you're going to do a 506C, of course you can do all of that. You can show all of your returns, all of your track record, all of that. But if you're doing a 506B, you're not allowed to show even the 506Bs you've done in the past. You're not allowed to show, because if you show a 506C, well, but I was allowed to, yes, but now a 506B investor will see that and make a decision whether or not to invest with you. Right? So no, you're not allowed to post that stuff at all. Now, it comes down to probable, possible. Is it possible to get your ass in a sling with the SEC? Absolutely it is, because you're breaking the rules. Is it probable that you'll get caught and sanctioned and fined? No, it's probably not going to happen, but why take that chance? Do things the right way, do things the legal way, stay within the lines, paint within the lines, and you do it the right way. So no, you're not allowed to do that. You're not allowed to solicit, advertise. They can be accredited unlimited numbers, or you can have non-accredited, but you're limited to 35 people that are not accredited, and you have to know them and have a pre-existing relationship with them. Now,
That's
on a,
interesting because I mean, like a 506C offering, you're allowed to go out and market it. So, like the
right.
provisionary, we've got a video out there on that offering because it was a 506C offering. I mean, isn't that technically the same if a 506B person goes out and sees that video and then decides to reach out to us and invest with us?
Well, no, because you're not. Well, yeah, I mean, I guess it could, and that's where
There's
we
probably,
do
I mean,
this
it's
a
probably a
lot.
gray line. I get it, but
Right. It might not be gray, but in my brain, it's gray. So that's why, again, guys, get professionals on your team. I've done a lot of these things, but there's always going to be something new that comes up and go, oh, well, how does this work on the next deal we're thinking about doing in the future? We're going to call our attorney, our
Always get your
syndication
attorney
attorney.
involved.
Exactly, because I honestly, I don't know exactly how that's going to play. So we need to figure out, well, maybe we've screwed ourselves up. We can't do a 506B again. I'm sure that's not the case. I'm sure there's somewhat of a cooling off period, so to speak, that from the time that video went up, and maybe we have to take it down if we think about doing a 506B. Maybe it says to do a 506B now, any marketing out there you now have to take down, you know, a minimum of 2 months before you charter your 506B. Once your 506B is raised and closed out and you've bought the property, well, now you can put that back up. I'm sure there's a way around it. I just don't know what it is. So I'm going to reach out to Gene, my syndication attorney, and say, okay, this is what we're proposing to do. How do I do it safely and within the rules? Good question, because I don't really know that answer yet.
Yeah, I mean that's the thing about syndication that I have realized is that there's an unbelievable amount of blurred lines and gray areas where if in the off chance that you're in the wrong, you're in a lot of trouble. So that's why we're saying, like, if you are interested in doing syndication, or if you're going to be doing syndication, at every step along the way, have your attorney review your materials, review your marketing language, whatever you're doing or going through, because you don't want to get investigated by the SEC. I mean, the thing that I think about all the time is whenever I'm talking to potential investors or whomever, is okay, if I'm having to give testimony in court one day, can I honestly say that I was looking out for my investors' best interests? Or, I mean, those are the kinds of things that go through my head that I never thought of before I started doing syndication with Bruce. Because if you're just doing a straight equity partnership and not a syndication, there's a lot that you can get away with that isn't regulated by those just aren't regulated by the SEC. So.
Right, because those are true partnership deals, because everybody in the deal has say in the deal. On a syndication, you've got one person or one entity operating the deal, delivering the returns, and the rest of the people just put their financial wherewithal within the hands of that GP that's going to run the deal, the operator. So yeah, it's not scrutinized the same way by the SEC. That's a good point. Um, so and then you've got a 506C, so that's the 506B. Now there are other nuances to it and to the 506C that we'll talk about, but I'm going to talk about the main things that you're going to be concerned about. So a 506C, you can only have accredited investors now, no non-accredited investors. You can now advertise and solicit, stand up in front of the room at a meetup and say, hey, I got a new deal going. Anybody interested? It looks to return maybe, a 12 to 15% IRR. Cash on cash looks like 8 or 9%. You're allowed to do that. And then somebody comes up to you, says, hey, I'd be very interested in that deal. Well, this evening when you go home, you can send them that deal. It's totally legit and legal. You don't have to have a pre-existing relationship with these people. You don't technically have to know them. I still would like to know them to make sure they're a good fit for us on a personality level, on a character level, that we're going to get along well. But technically, you don't have to know them. You don't have to make sure. Oh, one thing on a 506B, you have to make sure or have every reason to believe that they are a sophisticated investor. That's another gray. What is that? Well, there's no exact guidelines to what sophisticated means, but you want to make sure that they understand what the risk profile is. You want to make sure they understand what the returns look like, what those returns mean. What is it? It's projected to return a 5% cash on cash return. Well, what is that, Bruce? Okay, you're not sophisticated. You don't know what I'm talking about. Those are people that are going to get themselves hurt, and you're in charge of their money in this deal. So I don't think those people are sophisticated. They don't understand real estate investing. They don't understand return structure. They maybe not understand what accredited, all these things.
Well, and
506C,
when we went through our 506C for the provisionary, we had a third party verify that all of our investors were accredited, which I don't know if that's required or not, but we didn't want to take the liability at all of having anybody in our offering that was possibly unaccredited. And it ended up actually we lost a couple of investors because of it, because they thought they might be accredited, they weren't entirely sure. And I bet that happens all the time because it can change from year to year, right? So
Yeah.
I mean,
Yeah, so on a 506B, no, we don't have to verify their accredited status. They just check a box and they self certify. If you do a 506C, you can only accept accredited investors now, but now you have to take reasonable measures to verify that they are accredited investors. And to your point, Tyler, now we could do it ourselves. Ask for letters from your CPA, ask for your, past 2 years of tax returns. That's too damn much information for me to know about you. I don't feel comfortable with knowing all that stuff. That's too private for me to know. So we use an outside company called Verify Investor, verifyinvestor.com. And we reach out to them. I think it's $30 to $40 per investor that we verify, but they will now reach out to that prospective investor and get all the documentation they need. And then they just provide us with basically a certificate, if you will. It's basically just an email saying, yes, we certify that they are an accredited investor. But I am required by SEC regulations to verify they are indeed accredited. Don't try to get yourself into a 506C offering if you're not accredited. They're going to find out. Oh, but it's a great deal. They'll not. Yes, they will find out if they're doing things right because they have to verify that. So we've talked about they have to all be accredited. You can have an unlimited number of people. You're allowed to now solicit, advertise, talk about your deal, have things up on your website as far as past deals. You have to verify they are accredited. You don't have to verify that they are sophisticated because, in the eyes of the SEC, if you qualify as an accredited investor, they see, okay, you're a rich person. You are deemed to be accredited enough to have gotten yourself to the accredited status. So that barrier is gone too. You don't have to worry about that. Those are the main differences between the 506B and the 506C. Everybody would say, well, why would I not always do a 506C? I can now advertise. I don't have to know them. I don't have to know that they are sophisticated. Now, the only thing I do have to do is verify they're accredited. Well, piece of cake, I can do that.
that
Okay.
sounds like me back in November or October. Oh, well, let's
Yeah,
just do a 506C. We can just advertise the offering. It's easy.
exactly. What people don't understand is, wait, do you know enough rich people? Now, maybe you do, and that's fine. If you do, great. But do you have enough people on the sidelines to double or triple the amount of money you think you're going to need to do this deal? Because not all of them are going to come through with funds because they don't have them ready to go. They've already invested in some other deals. Do you
and
know
how
enough rich people to fund your deal?
and how
Most
many
people don't.
people are willing to just give a stranger $50,000 or $100,000? Like, I think that ends
Yep.
up being the biggest barrier there. I mean, everybody that we had come in ended up being a friend of a friend or a contact through our network, right? So
Right.
they might have been an extended contact through our network that we wouldn't have gotten if it was a 506B. I mean, they technically probably couldn't have been in a 506B, but it wasn't like I think we might have had one person come in that we'd never met before. Everybody else was through someone else, which I thought was actually pretty interesting, but it makes sense when you dissect what the psychology is behind the offering, right? I mean, you've got two guys, you've got Tyler and Bruce out here doing a video on YouTube talking about this deal. And yes, we've got excellent track records on the deal, but at the same time, I mean, I'm not just going to go give some random guy $100,000. You want to vet it, you want to see, you want to get to know them. So it's a much different process than a 506B, that's for sure.
Right. Because, yeah, to your point, everybody thinks, oh, I've got a slamming deal. I've got a 20 IRR, and that's better than most deals that are out there. We'll be able to fill this up immediately. Yes, but if they don't know you, like you said, Tyler, they're still not going to give you money. You think because I advertise it, everybody's going to line up and throw money at no. They're interested in the deal, but then they go, oh, but I don't really know this person. So most people are not going to come in without knowing you. So the one person you talked about that we didn't know that came into the deal, we now know them. right? Because now we've gotten to know them. So they reached out to us cold and said, "Hey, I just saw you on YouTube. I'm interested in talking to you about the deal." So I had a few conversations. Some of my back office investor relations people got involved. They talked to them a few times. We got to know them fairly well and felt that you are a good fit, because just because I don't have to know you, I still want to talk to you and see, even though I don't need to know that you are sophisticated, I want to know that you're sophisticated. Because if you're not sophisticated, you're going to make our job a nightmare going forward when we start sending out financial updates. And you're like, oh, the distribution that you sent me was, $2,000 this month. That's fantastic. But how much of that was principal? How much of that was interest? Because I've had that question. It's like, what the hell are you talking about? That makes no sense. Distribution has nothing to do with principal and interest. Those people aren't sophisticated. And if I would have talked to them enough at the beginning, I would have realized they weren't sophisticated, and I would have been very professional, very respectful. But I would have told them, look, I don't think this is a good deal for you, at least not now. You need to go get yourself educated to make sure you know what it is we're talking about, because I don't have time to teach people what all this stuff means as we're going.
Yeah, I mean that's so I had a call with a guy out of Atlanta the other day, and he reached out because he had seen one of our projects, um, in I guess in the newspaper or something like that, and he was wanting to get invested in our deals, and we were just having a conversation, and so he was asking questions, and I said, look, I mean, you and I need to go out and grab drinks. We need to get lunch together. We need to get to know each other, because one, you shouldn't just invest with somebody you've never met. But two, I don't want somebody that I've never met really investing in my deals, because we've got to have these conversations. We've got to make sure that, we're on the same page first off, because, if you think you're going to get a 2,000,000% return and you've misread something or whatever, like we need to address that on the front end and set expectations. But also, as an investor, you shouldn't just take the risk and just throw money at it because you think it's a good deal. I mean, it's good to get to know each other. At the end of the day, right, like Bruce and I are still human beings. It's not like we're just machines that are here to, that are perfect, right? I mean, I could get hit by a bus tomorrow. And what's our contingency plan if something like that happens? I mean, those are all the questions that as an LP, if you're looking to invest in other people's deals, that you should be asking.
Yep, I agree. So even though the requirement isn't there to know people, I really believe the same thing. You need to know these people because, I've heard stories. One guy was coming into somebody's investment, and they were doing a 506c, so they didn't have to know them. But so as this guy he's deposited his money. They haven't closed on the deal yet, so he's not officially in the deal because it hasn't closed. So midstream, he says, "Oh, okay. So I'm a commercial insurance broker. So since I'm going to be in the deal, I require you to let me bid on the insurance for this property." He's like, "What do you mean require? I'm giving you money. You must. I must not do anything. If that's here's your $100,000 back, Junior. I don't need you. You need to know who these people are. Some people are nuts. I'm sorry, guys. If that's you, you're freaking nuts. Just because you get into a deal doesn't mean I owe you stuff outside of being a fiduciary of your money. But I don't owe you deals under the table. I got to give you the insurance on that. That's ridiculous. But that guy thought that. So luckily, they hadn't closed the funding round yet. So they just said, you know what? You're not a good fit. You're irrational, unreasonable, and an idiot. Here's your money back. Go away. There's another deal for you somewhere, but it is not this one.
Look, I mean, one thing that we always do is if we have an architect investing in our deal, he's going to get a shot at doing the architecture on the project.
Right.
That doesn't mean that he's guaranteed to get it. Same as if you're a contractor or you're an insurance agent or whatever. I mean, of course, we're going to offer that to you, and maybe you'll get first shot. Maybe you won't get preference, but you'll get first shot to make it happen. It's just, professional courtesy, and we all want to win together. And look, at the end of the day, it's like what Bruce and I have talked about before with the brokerage and the property management side of things. We're going to have to hire those out anyway. Well, Bruce and I own a brokerage, and Bruce and I own a commercial property management company. So we're going to get first shot at doing that. We're going to pay ourselves market rates. We're not going to give ourselves above market rates because, again, if something happens and we have to hire a third-party manager, we're going to have to pay market rates. Nobody's just going to come in and give us a deal or whatever, you know?
Right. So last thing before we move on to promote, just for some clarification there, that you would think it's obvious, but not to everybody. You said, look, if you're an architect and you're coming into the deal, well, we're going to give you first shot. Well, let's put that into perspective. Let's say you're an architect, and this is an extreme example, a weird, just off the cuff example, but let's say you're an architect, but your experience is designing dog houses. Okay, well, I guess an architect could do that. Well,
Make
I'm
quite a
not going to
living
give you
designing
first
dog
crack,
houses.
third crack, or 80th crack at doing the architecture on, a 37-story high-rise building in downtown Austin. Yes, you're an architect. I'm not going to give you a shot at this because that's not what you do. You're an architect, but you're not the right architect for this job. So your point is absolutely right, Tyler. If they're a good fit, then yes, we will bring you into the bid process, but you have to earn the business for the project. We're not just going to give it to you because you are an investor. Good point.
Yeah, exactly. Okay, well, before we move into promote, I want to cover like equity, right? The equity
Okay.
splits, because I think that makes sense to dive into before getting into the promote. So, what
Okay.
what are the typical equity splits that you see? How is that structured? What do you prefer to do? What are the implications of different equity splits between the GP and the LP?
Okay, so I'll talk about what I typically see, and I'll tell you about some of the outliers that I've seen also that I've actually invested in myself that were extreme outliers from what you typically see. But then I'm going to break that down into, what exactly is a promote, because we're teaching you concepts here. You got to decide what promote structure is right for you. What we usually see in multifamily, either multifamily and commercial, whether it's development or if it's, buying an existing building, it's usually going to be an 80-20 or 70-30 split. On a development, it might be a little higher promote, so maybe a 35-65 split. In those splits, typically the larger number will go to the limited investors, which the general partnership, the managing partner, the operating partner of this deal, there's a very good chance a lot of their money will be invested too. So they will have general partnership shares, but they will also have limited partnership shares because they're going to invest their own money too. So keep that in mind. But on an 80-20 split, let's say, typically the 80% goes to the limited partners, 20% goes to the general partners. So usually I see a 70-20 or an 80-20 or a 70-30 split. Now, I invested in a very hot restaurant concept developer here in Austin. They have a huge track record. They have lots of restaurants, super cool, popular restaurants in Austin. I wanted to be part of their team as a limited partner. So I invested with them. Their structure was a 55-45 split in their favor. As a limited, I get 45%, they get 55%. But that promote split does not kick in until I get all of my capital invested back to me in the form of distributions. And they project that to take about 4 to 4.5 years through operational cash flow. Once that happens, see, before that happens, they don't get any split at all. They just run the deal. They get an asset management fee, but that's it. Once I get all of my capital returned to me, then it turns into a 55-45 split. The general partnership gets 55 and I get 45. Again, most common that I see within commercial real estate is going to be an 80-20 or 70-30. But let's say you have a deal that you are in love with as a general partner, as a syndicator. I need this deal because the upside is huge. The only way the deal works for your investors to get the return that they need to invest, maybe you can't even afford an 80-20 split. Maybe you can only afford a 90-10 split. Well, how bad do you want the deal? If you take it out to the market at an 80-20 split and everybody goes, well, I don't want a 2% return or a 3% return, well, then you're probably going to have to drop your promote or just drop the deal altogether. Again, these are guidelines. This is what we typically see. But as a syndicator, you decide what's right for you and your investors and what your investors need.
Yeah, we recently did a deal. I mean, like Bruce said, most of our stuff is in 70-30 range in favor of the LP, but we recently did a deal where it was 70-30 in favor of the GP because the deal that we found was such a screaming deal. I mean, we bought it for less than a quarter of what it would cost to build that building back. And so when you think about a project like that, so we gave the LP 30% plus a promote. and they're getting just as good a returns as we typically do on like, a multifamily stabilized project, right? Because it was such a good buy. So it depends. I mean, it can be all over the board, really. It just depends on what you think investors are willing to invest with you, the kind of return that they need to get. Bruce, I mean, what you typically, and as a consequence, I typically do this, structure a straight split, right? Where it's 70-30. Maybe you'll have a pref in there, but it's 70-30 after the fact. That's really interesting that you bring up the point that restaurant group did a 55-45, but they returned all of the investor capital first, and then they went into that bigger split. I mean, what are the pros and cons of doing a pref then 70-30 versus we're going to return all of your capital and then we'll split 55-45?
Well, for them to do what they did, they have a lot of confidence that they're going to be able to deliver. Because if they're not able to deliver all my cash back to me, they're never going to make or promote. So they have a high degree of conviction. That makes me feel good. I'm willing to take a 55-45 because they're giving me all of my money back before they get a dime. But even with the 55-45 split, they still project my annualized cash on cash return will be 12.5% until this property sells. It's a 10-year hold in their opinion because they think they're going to be able to package enough of these properties together and sell it to one of the large multinational companies like a Darden that owns all kinds of different restaurant concepts. So that's the thought. But yeah, I'm totally fine with that. They like it because that tells me that they're very convinced they can return all of my money to me in 4 to 5 years. So I actually, yeah, it threw me for a loop when I first saw it. I was like, whoa, 45% for me? That's all. Oh, wait, but now wait, they're giving me all my money back before they take anything. So they're incentivized to perform for me. So I had no problem with it. Now, most people, honestly, I don't think as a limited partner would be comfortable with that deal. Totally fine. Again, if nobody was interested in the deal structure they presented, they would have had to change the deal structure or they wouldn't have been able to raise any money on the deal.
Is that a structure that we should look at or that we would
We
consider
could.
for doing some of our deals?
We could. We could do anything we want as long as it works for the investor in a way that they need it to work, right? For most sophisticated investors, they don't care what the structure is as long as it delivers conservatively and they have faith in our ability to deliver the return they're looking for. If I get a 30% promote and you get an 8% return, but you only need a 6% in return on the things that you invest in, well, then that's fine. But some people go, well, no, I don't feel comfortable with anybody taking more than a 15% promote because I just, that's greedy. Well, what do you need from an investment? Well, I need at least 6% to invest. Well, even with them taking a 30% promote, they're projecting to give you a 9% return. So it shouldn't matter because the operator is doing all the work. You're doing nothing, right? They're signing on the debt. They're taking all the risk, all the stress, all the liability. Now, of course, you do have financial risk, no question. You could lose your investment, but so could the GP, the syndicator, because they're likely putting their own money in the deal as well. You just got to decide, is the structure being presented to me, does it provide the return projection that I need to consider an investment? And do I feel confident in their ability to hit that projection? If so, I, as an investor, because I invest in a lot of crap that I don't run, as long as the return that I need is there, I don't give a shit what they get. If they're proven, if they have a good track record, and I have confidence they can deliver the numbers they project to me.
So I always find this fascinating, and I'm starting to do this myself as well, but I want to get your opinion on it. As a GP, as a deal promoter, you can go out and put very little capital into these deals and get a great return on your time, energy, and expertise. So how do you justify placing capital in somebody else's deal when you could likely get a better return doing your own?
It's diversification. What happens if something like I primarily, for multifamily, anyways, I primarily invest in Central Texas. What happens if something happens in the Central Texas market? I want to be diversified. So I have some syndicators in my Rolodex that I completely trust. I know they're good operators. I know they're good character people and they have a good track record. So I'm always, it's just a diversification play for myself. That's it. We have the holy grail for everybody listening is I got to get passive income, got to get passive, got to get passive, right? Well, I have a lot of passive income in theory, right? But if everything I do, all of my passive income is from the stuff that I own, right? My distributions technically are considered passive income, but it's only passive income based on my efforts as a management company and as a syndicator. So even though within the IRS structure, it's considered passive income, I don't really see that as passive because I still had to work myself to get it. So I want true passive streams of income. So I will invest in other people. Most of the successful syndicators that I know, they invest in all kinds of other deals, not just their own. But I understand what you're saying. You'll get a bigger return on your money if you invest only in your own deals. But again, to me, that's not truly passive. I want some real passive income myself.
Yeah, and that's what I figured your answer would be. That's I'm starting to get to a point where I'm looking to invest in other people's deals, and I'm starting to. I mean, I'm looking at investing in a hat company here in Nashville, and kind of diversifying through other business ventures that I believe in for that exact reason. Just so that again, we're making money. Let's put it to work in a way that I don't have to go out and continue working to keep making it. So, um,
Exactly.
yeah, I like
Exactly.
that.
So,
Okay, so
all
we've
right. So,
covered the various equity structures. So now let's dive into the promote. So, Bruce, what is a promote and how does that work?
so promote basically, like you said earlier, you're a promoter of the deal, right? So it's your job to go out and raise money for the deal. Most promoters are also going to be the deal operators, the operating partner. But the promote is basically the premium compensation you're going to receive as the deal operator. Now, you might not be the operator, you're just syndicating, meaning you're raising money from other people to then go take that money and put it in some operator's syndication. So you're still technically a syndicator. You're just bringing people's money together to go out and do something as a group. That's all a syndication is. Now, if you are going to be, excuse me, if you're going to be the actual deal operator, you'll get a promote. Well, even just every syndicator will get a promote because they're doing work to place your money if they're not the deal operator. They're still placing your money by vetting deals all day. But the promote is the compensation for running the deal, for providing you with your return. Again, they're going to sign on the loan almost always, which you as a limited partner will almost never sign on a loan unless you agree to it. You don't have to unless you agree to do it. They may ask, but you could say, no, I just want to be a true limited partner. So for signing on the deal, taking all the headache and stress that comes along with managing the deal, even if you don't have your own management company like Tyler and I do, you still have to hire a management company and oversee that management company. You're probably going to be the asset manager. So you're doing a lot of work that a limited partner is not going to do. A limited partner does nothing. They go to work every day at their regular job, or they travel if they're retired, they hang out with their family. They don't do anything. I need to be compensated as the deal sponsor or the syndicator to do the deal. If not, why would I do the deal? Makes no sense. That's what the promote is. So we talked about equity structures, 70 20, I mean, 80 20, 70 30, 55 45, 30 70, all kinds of different structures. And again, that just depends on what you can sell to your investor base. What I want to talk about now on the promote, we know what a promote is. We know some of the typical structures and splits. There are two main ways that I see you can structure your promote. You can do it in the form of an override, or you can do it in the form of equity, and I'll explain both. When you do an override, um, I don't think these are like Investopedia, official definitions, but this is what I call them, right? So an override means, let's say I have a promote of 20% and I take that promote in the form of an override. Let's say in quarter one, I send out a distribution to my investors of $100,000. I have an 80-20 split or a 20% promote. In an override situation, that means that I'm going to take 20% off the top, $20,000. That will be my compensation for running the deal. That's my promote in the form of an override. Now, before, so whatever's left, the $80,000 gets split evenly, not evenly, but on a pro rata basis throughout the limited partners. So, as a limited partner, if you put in 10% of the money to buy the deal, you would get 10% of that 80,000 because the override comes off the top and what's left then gets distributed on a pro rata basis to the investors. Now remember, as a deal sponsor, I probably have invested my own money, so I will get that 20% override, but I will also get my percent ownership share of that remaining 80,000. So if I put 10% of my own money in the deal and I have a 20% promote, I get $20,000 for my override, and then I get 10% of the remaining $80,000. So I get another $8,000. So my total distribution would be $28,000. That's what an override is. Now, the way I do it, I've done it as an override, but what I do nowadays is I take my promote in the form of equity. It has roughly the same result on cash flow distributions, but there are some reasons I choose to do it this way. So what'll happen? Let's say I'm doing a deal and I sell 1,000 shares at $1,000 per share. I'm going to raise $1,000,000. I think that's that math, right? 1,000 times 1,000. Yeah, I'm going to raise $1,000,000, right? So I'm going to sell 1,000 shares. When it's all done, I've raised all $1,000,000. I've sold all 1,000 shares right before we close the deal. I will stack 20% more shares on top, right? Because that's my promote is 20% equity in the deal. So now by giving myself 20%, once it's all done, now I have 20% ownership of the deal that serves as my promote. So now when we do a cash flow distribution, quarter one, we send out $100,000, same example. Now, what happens is we all just get our pro rata share of that distribution, period. There's no, I'm taking 20,000 off the top and everybody shares pro rata on what's left. I own 20% of the deal now. So everybody gets a portion of the distribution equal to their share ownership. I have put in 10% of the deal in cash, but my promote is 20% and I took it in the form of equity. So now I effectively own 30% of the company. Think about it like Shark Tank. I am selling 80% of my company to outside investors. I will retain 20% ownership in the company for all the work that I did to bring the company to life, to run the company on a day-to-day basis. But I'm only selling 80% of the company to outside investors. So if you contribute 10% of the money needed to go buy that property, you will own 8% of the deal. Because remember, you're only buying 80% of the deal. So 10% of that 80% of the deal, you will own 8% of the deal. It's roughly the same effect on a cash flow distribution. It's a little bit higher for the promoter, for the operator, for the deal sponsor or syndicator, but it's not much, right? The main reasons I do that, there's two main reasons. If I do an override, I don't get additional equity. If I do it the way I do it as equity, now I have equity. Well, that is something that I can claim on my personal balance sheet or my personal financial statement. And that's important only because when I go sign on loans as the deal operator or the syndicator, I have to have basic rules of thumb. There are exceptions to this, but basic rules of thumb. If I want to go get a $1 million loan, I have to be worth at least $1 million. And I have to have liquidity equal to somewhere between 10 and 30% of that loan value after we close the deal. I still have to have that money in a bank account somewhere, basically, right? So when I take ownership of the company for my promotes, there's a value applied to that ownership stake, right? So let's say the equity in the deal. So let's say it's a $10 million deal. You are going to put $8 million in loan on the property. That means you have a $2 million down payment. Well, that down payment is equity. That's equity in the deal that the bank is requiring you to put down. Well, because I take my promote in the form of equity, right? I get 20% of the equity as a promote. So that $2 million down payment, which is the equity in the deal, I own 20% of that, right? $2 million in equity. I own 20% of that. I now have $400,000 in equity that I can list on my balance sheet or personal financial statement the day we close the deal. Again, that matters to me because that means I can get progressively larger and larger and larger loans and larger properties as we go. That's a big deal for a syndicator. That's signing on the loans that you are not signing on if you're a limited partner. The second main reason, the second big reason that I do it, we invest in real estate because we have unbelievable legal and legit tax advantages to doing this. So when you do these deals, you have something called depreciation. Depreciation says that the deal that you buy, a physical asset in the eyes of the IRS, will wear out over time if you don't repair it. An apartment complex, the IRS has said, will wear out and fall apart and dissolve into dust into the earth within 27 and a half years if you don't maintain it and repair it. So what they say is the value of the property less the land doesn't wear out. So let's say that $10 million deal, 80% of it is the buildings and everything built on top of the land, 20% of it is the land. $8 million of the property is now depreciable, right? You can write it off each year. So you take that $8 million, you divide it by 27 and a half years. So it means every year the property will be worth $290,000 less because it's wearing itself out. It's the same concept with a car or any other asset. So what happens, that depreciation expense, this is very high level discussion here, but I'm still going to try to keep it dumbed down a little bit or very, basic. So that $290,000 in depreciation expense, if I structure my promote in the form of an override with no equity tied to it, I only get my personally contributed capital benefit of that $290,000. Remember, in our example, I contributed 10% of the cash needed to buy the property. So I would get 10% of that $290,000 in depreciation write off. I would get 29,000, right? If I take my promote in the form of equity, remember, I get 20% equity for my promote, and I bought 10% of the company as a limited partner as well. So technically, I kind of own 30% of the deal. It's not exactly 30%, but it's real close. So I own 30% of the deal. So now instead of $29,000, I now get what? $76,000, 29,000 times 0.3. I would now get $87,000. So instead of $29,000 in depreciation benefit as a non-equity promote, now I get $87,000 in depreciation expense that I can now take and apply to my personal 1040 return that I have to file with the IRS every year. That's a massive difference. I just tripled the amount of depreciation expense that I get as the promoter or as the syndicator. Those are the two main reasons I do it. Before you decide to do either one of these, you better go consult with your tax professional, your CPA, somebody that can help you make the right decision for you because all of us have different tax situations. Make sure you know there are some things to be careful about when you do this. If you structure it in the form of equity, if you don't buy that equity for something, even if it's for $10, you got to buy it for something, or the IRS sees that was compensation and you owe money on that promote that you got on the day you closed, right? So on this, remember, it was a $10 million deal that had $2 million in equity, right? So I had $2 million in equity and I had a 20% promote. So I have $400,000 in equity the day we close because it's formed equity. If I don't pay for that $400,000 in equity, it's seen as compensation in the eyes of the IRS. Guess what? Compensation gets taxed. You're going to have to pay a tax usually within 3 months of the closing of that deal. So let's say you're in the 25% tax bracket. Ouch, you're going to have to write a check to the IRS for $100,000. It's a paper gain because it's net worth. You don't have it in your pocket. It just hits your balance sheet. So now where are you going to come up with this $100,000 tax bill that you have to have to write a check for? So be very careful if you do the way I do. It's a very good way to go about it. I think just better really across the board, but it still has roughly the same net effect to the investor. But if you do it wrong, you're going to get yourself screwed up with the IRS.
Yeah, I mean, just to further demonstrate how powerful the depreciation in commercial real estate is, there are investment groups out there, and we've spoken to them before, that are interested in investing in real estate syndications for the primarily for the benefit of the depreciation that comes from those write-offs, because it helps them shelter income that they've got coming in elsewhere. So, Bruce and I have talked about this before. There's cash flow plays, and then there's long-term equity plays. And you kind of want to balance them both, because the cash, the equity plays can help, with the write-offs, shield the income from the cash flow plays. So definitely want to make sure that you stay on top of that.
Exactly. So, yeah, some people will do a deal that loses money because they need the write-offs, right? They're looking for the depreciation expense write-off, and they're looking for a project that technically will lose money. And that's why people invest in LIHTC, low income housing tax credit properties. People invest in all kinds of supplemented things that you're getting tax abatements for because they need tax write-offs. Well, that's what depreciation expense is for the rest of us, right? So again, do it however you choose, but that's my high level view of the two big different ways to structure this. Again, talk to your CPA, your tax accountant, your tax advisor to make sure you're doing the right thing for yourself. Just be real careful.
Yeah, always consult the professionals. So definitely don't listen to me and Bruce. This is for entertainment purposes only.
Well, yeah, and
Get
it
your
comes from
attorney, get your
years.
CPA.
Right. It's years and years of experience, but
Yeah.
we are not professionals in that. We are not tax professionals. We are not attorneys. You've got to get your people involved. Say, this is what I heard some people talk about on YouTube. What do you think? And maybe they go, in your situation, that's a horrible idea. Let me tell you why. For
Yeah.
me and Tyler, it works very well for our tax structure. It might not work for you. So please go talk to people.
Yep, absolutely. So, okay, we've covered equity structures. We've covered promotes. What about preferred returns? How does that work? How do you typically see those structured?
So I wrote an article on LinkedIn, apartment guy, Bruce Peterson on LinkedIn about preferred returns, what they are. And then I also wrote an article as to why you might not see a preferred return as a limited investor and why you might not even want a preferred return as a limited partner. So what a preferred return says, it's no guarantee. First, let's understand that. A preferred return does not, oh, I get a guaranteed 7% return because that's what my preferred. No, a preferred return for the most part, and basically there are exceptions, like everything else, there's exceptions to this. But what it typically is, the syndicator or the deal sponsor will not get their promotes until you, as a limited partner, get your preferred return hurdle met. So let's say you have a 6% preferred return. The first 6% of cash flow distributions that go out to the partnership only go to the limited partners. Anything above that, the syndicator or the deal sponsor will now take their promote on everything above the 6%. So let's say in year one of operations, you have an 8% profit in distributions to send out, right? So on a 6% preferred return, the limited partners will get all of the first 6%. Then the extra 2%, the promote will be paid on that 2% only, not the 6%. That's the basics of a preferred return. On a preferred return, it might not generate enough profit on an annual basis to satisfy the 6% return. If you don't hit that hurdle, well, then the syndicator or the deal sponsor will not get their promote because they didn't hit their minimum requirement for you in that year. Very often, what will happen is when they do a cash out refinance or they do a sale at the end, whatever shortfall they had, let's say every single year, they can only deliver a 4% return to you. Remember, a preferred return is not a guarantee. It's they will only take their promote on everything above the preferred. But let's say they only develop 4% profit throughout the entire whole period, say for 5 years. So each year for 5 years, you're short 2 points every single year. 5 years, you're short 2 points every year. So you are missing 10%. At the end, when you sell, they have to pay off the original loan. They have to pay the final bills, all the fees, commissions, all that stuff. But then before all the split happens, you have to pay them as the syndicator that missing 10%. You owe them that. You had a preferred return that you didn't meet. So you got to make them whole first on the preferred return. Then you will probably end up splitting on an 80-20 or a 70-30 basis, whatever's left after that. Now, again, there are more things that go into it than that. Are you subordinate? Are you not subordinate? And we'll go into that in a second. But that's what a preferred return is. But there are all kinds of different types of preferred returns. Is it pari passu? Is it compounding? Is it what am I? I completely lost the other one. Preferred is it accruing, pari passu, or compounding? Basically, if if it's a compounding preferred return, please go read my article. It'll help. If it's a compounding return, let's say in year one you have to hit a 6% preferred, but you only hit four, right? So the next year, your hurdle is not 6%, it's 6% plus last year's miss of 2%. So for the second year now, you have a hurdle of 8% before you get your promote. Let's say you go for the first 2 years and you miss it by 2 points each of the first 2 years. The third year, you owe them the 6% preferred plus the 2 point misses each of the last 2 years. So now you have to give them 10% before you take anything. That's if it's compounding. Very often they're not compounding, they are accruing, meaning at the end when the property is sold, any shortfall they'll make up for you at the end. That's it. Pari passu means I will give you a 6% preferred return and I don't get a promote until we hit the 6% return. But pari passu basically means we do it at the same rate. If I hit a 6% hurdle, then every dime of that 6% I get a promote on, plus everything above. But if I don't hit that 6% preferred with a pari passu, then I don't get any promote, right? So if I hit my 6% threshold or my hurdle, I get paid on all 6% of it. But if I only hit 4%, I don't get promote on any of it. I hope that makes sense, but that's what pari passu is. So that's what a preferred return is. There are different ways to structure that preferred return: compounding, accruing, pari passu, non-pari passu. Remember, it's not a guarantee of anything. It's saying they won't get their promote until different structures and hurdles are hit.
So do you commonly see pari passu? I mean, I feel like I hear that word all the time.
Yeah, pari passu just means at the same time, basically.
Yeah.
I've got a buddy, all of his stuff is done pari passu. So some people would say, well, but that's not good. He still gets a promote. Yeah, but he doesn't get a promote on any of it until he hits a threshold. So he has incentive to hit that threshold or he doesn't get his promote. So I've got a buddy that everything he does, it's always a pari passu. It's not super common, but it's definitely out there.
Yeah, kind of like what you were talking about earlier with the restaurant, right? I mean, it's one of
Yep.
those things where like, yeah, I mean, they're getting rewarded for it, but also they have to hit that first before, so that you're getting the LP their money and then the GP gets rewarded. So, I mean, those are the major deal points. I mean, I know we're going to get into subordinate, non-subordinate, um, that you'll see in most syndications. I mean, let's dive into waterfalls because I feel like
Okay.
waterfalls are where most of these deals get really convoluted and it's very easy to screw up how your waterfalls are structured and make an LP investor feel like they're either get confused or feel like they're getting screwed over at some point. So talk about waterfalls and how those work.
So a waterfall just means that there are steps of compensation for the promoter, for the syndicator or deal sponsor. So basically, let's say I sell the property, and most of the time they're tied to IRR, but let's just say they're tied to a return. So you sell the property, and the limited partner, it's going to return a 10% return when you sell it, right? So up to 10% profit, I will take an 80-20 split, meaning I will get a 20% promote. So I get 20% of that profit. The limited partners get 80%. On a waterfall, maybe it'll say, okay, everything above 10% to 15%, I'm going to get a 30% promote because I really, really performed well for you, maybe. So I deserve a little bit more money for it. So then that next 5%, they're going to take 30% of that next 5%. And let's say they have another level in this waterfall to say, okay, anything above 15%, I'm going to get 40% of that. So let's say they have a 20% profit. The first 10%, you're going to split 80-20. The next 5%, you're going to split 70-30. And the final 5%, you're going to split 60-40. That's the basics of what a waterfall is. You got to understand what it is when they're talking about this. Know exactly how it's going to play out for you as a limited investor. If you're the syndicator, know what this means. Make sure you track it effectively and appropriately. If you don't, you're going to screw it up because it gets complicated. You better have a good bookkeeping team and an accounting team on your side, unless you're an accountant or a bookkeeper yourself. Maybe it's easy for you to figure out this stuff and, create your spreadsheets, but it's a more complicated deal. I don't do them. I've never done a waterfall. I probably never will do a waterfall because it gets too complex. I don't need to bleed the deal of every single penny of profit I can pull out of it as a promoter, as a syndicator. It's not saying that people that do waterfalls are bad. It's a perfectly legitimate way to do it. If you're going to invest in somebody else's deal and you're comfortable with that waterfall structure, fine, invest in it. I don't do it because it gets a little complicated. A lot of investors will go, "Oh my God, this is so hard to understand." Forget it. You're saying it's a 500% return every day, but I can't follow it. I can't figure it out. It's too complicated. I'm out. So I don't do it for that reason myself.
Yeah, I've seen some waterfalls structured in a way where it doesn't necessarily just have to be on annual returns, right? I mean, the thing about syndications is you can get, I mean, as creative as you can be, you can structure a deal. That's just how it works. Whatever you want to do, you can do. So it could even be hey, it's an 80-20 split until we've returned all of the LP's original investment, and then it's a 55-45. There's any number of ways that you could really come in and structure these deals. And I think that's why it gets so complicated and confusing for people. Bruce, what else do you want to cover? So we've got subordinate, non-subordinate. Is there anything else other than that?
The only other thing to understand, because we're trying to cover the things in a deal structure as a syndicator, you need to think through. Secondly, as a limited partner, you need to understand what these terms mean. Again, I've written articles about all this stuff on LinkedIn, so go read there, so you can read it at your leisure, and you can have it soak in or watch the video multiple times here. But I want to talk about subordinate, non-subordinate, and return on versus return of. Now, we can start the next episode diving into that. We've covered a crap ton of stuff today, or we could take another, 20 to 30 minutes to go into that. What, do you want to keep going, or do you want to kind of pick it up next time?
Let's dive into that on the next episode. I think that there's a number of other items that we could throw in there, and just keep the conversation going.
Okay. Yeah. Like I said, I just don't want people's eyes to roll back in their head. Oh God, now I got to keep up with that, and I got to take notes there. And I want to try to give it to people listening in fairly bite-sized pieces. Although we've covered a ton of stuff today.
Yeah, we can kind of do a part 2, and then, I mean, we may be able to on the next episode just dive into some of the structures that we've done and how those turned out. But I guess if it's a 506B, we can't really discuss that.
We got to be careful there for us as syndicators. But what I think we can do is we'll go into subordinate and non-subordinate, return on versus return of, but also go into, and we've kind of hit on this high level, and maybe even spend a whole episode on it. I don't think so, though. But we'll go into the ways that as a syndicator, you can be compensated for all the headache, hassle, stress, and liability you're going to take on. So we can roll all that into the next episode.
Yeah, I think that's a good idea. All right, everybody, don't forget to tune in live Fridays at 10 a.m. Central Standard Time if you want to ask Bruce and I any questions on the topics that we're covering. If you're following us on YouTube, don't forget to like and subscribe. And if you're listening on the podcast, please rate and review. That certainly helps us get this information out there to other people who are interested in commercial real estate. So until then, we will see you next time.
Later, guys.